Alrighty guys, coming into the first stock of the three. This one's a pretty small company, much smaller than a lot of the companies I usually invest in, but this one is named At Home Corporation, alright? Ticker symbol HOME, pretty easy ticker symbol to remember.
So hold on, no, you're not on the wrong channel. That was just a snippet from the financial education channel where he discussed a new stock that he's interested in purchasing and I believe already has purchased. That's called At Home, ticker symbol HOME. And Jeremy, if you are watching this video, there's absolutely no hate here. Everyone has their own investment theses about their stocks, and I totally respect that. I just wanted to provide my opinion here on this company. Now, the reason that I'm making this video in particular and picking this stock in particular is because a lot of you have been asking me in the comment section down below what I think about this stock as a potential investment. So what I want to do today is go through the company's financials, look at the stock, and kind of figure out if this actually is a company worth looking into or if it's a company that I personally would not consider investing in. So this business actually is very simple. They sell products for your home. And these things range from furniture to garden decorations to rugs and a lot more because they do boast over 50,000 unique items for sale in their stores. And this store is completely against the grain here because in a world where things are shifting to more of an online system, this company plans to focus on retail, and this, in my opinion, may be a fundamental flaw of the business. But more on that shortly. So let's start off with their recent earnings report, which was reported back in June. So here you can see that Q1 sales were actually up around 19.6% year over year, but the big red flag here is that comparable store sales decreased 0.8%. Now, when you're looking at retailers, what you actually want to compare here is their same store sales because this gives you an indication on the strength and demand for the company and their products at each location. Now, seeing sales decrease here was not a good sign first off for me. Now, on the good side, we actually see Q1 EPS was 21 cents and the adjusted EPS was 3 cents, and they raised their 2020 guidance, so these things were looking a bit better. Now, their CEO also released a statement that I was not too thrilled about. Essentially, he says that yes, sales were tough in the quarter and they are blaming bad weather for this. Then he goes on to say that there was a near 20% growth year over year, like we just saw, but EPS was at the low end of their guidance, which is not a strong sign for growth. For a growth company, you want to see EPS on the higher range of guidance or even exceeding their guidance expectations. Okay, so now let's pause and talk about this. So the first thing they do is actually they blame the weather. And in my opinion, there is some truth to this, but it's kind of a cop-out. It's kind of an easy way to get out of this situation and say, you know what, our sales were not strong because the weather wasn't cooperating, so people didn't come in store and shop. Now, sure, that is technically an argument, but when you enter the retail space, that's something that you're actually accepting and you're challenging. And by blaming it now, you're actually backpedaling and saying, you know what, the weather didn't cooperate, we couldn't do anything about it, so that's why sales are poor. Maybe in summer, sales will be better when the weather is better. Now, as a potential investor, that's definitely not something you want to hear because it doesn't instill any sort of confidence in the business at that point. But then what he also went on to say was that they actually went out and marked down prices to clear out inventory. And because of this, they naturally took smaller profits on the items that they sold. So here what we have is a company that struggled with weather and cut their margins, so they took in less profits. So that's two things now that they have going against them. And honestly, what I see here is this is a typical issue that retailers have. They have a hard time getting people into the door, so what they do is they cut down prices to entice people to come into the store in hopes that they buy more than they actually planned to initially. But that's kind of an uphill battle, and I'm not sure that this company can actually get past this. And the reason is because this is exactly why people have shifted to online shopping. Websites like Wayfair have picked up extreme popularity in the last few years, and that company is thriving in my opinion because they offer the convenience and the flexibility to shop for any household item on their website shipped directly to your door. And of course you have competition from other companies like Amazon even that's entering this space. So I think it's pretty fair to say that competition is not going to get any easier in the next few years. It's going to get a lot more tougher in fact. You got to keep in mind that this isn't really a business where you have to physically go in store to purchase the item. It's not like a Home Depot or a Lowe's where you got to go in and get a custom size of wood or something like that. We actually have to be in store for. And like I said, with companies like Wayfair and Amazon that offer free returns, there isn't really much of a downside to purchasing an item and then you find out, okay, maybe it doesn't really fit my home, I'm just going to ship it back. In this day and age, thanks to Amazon, returns is a very normal thing, and it's something that a lot of us go through whether we shop at Wayfair, Amazon, or any other online retailer. So I don't really think that shopping in store has much of a benefit here for this kind of industry. And that was just kind of the online space competition. I also believe that the retail space competition is very fierce in this department. You have companies like Bed Bath & Beyond, you have companies like HomeSense, even companies like IKEA that are competing in this space. So I don't really know if At Home can really muster up as much market share as they plan to and become a big player in this space. The one thing that I think could potentially differentiate them from a lot of these other retailers is if they ramp up their online website much quicker than they are right now. Because as of today, you cannot shop online at Home, and they clearly state that on their website as well. But if they manage to properly figure out a system, catalog all their products, and have a very easy to use experience like Wayfair does, they may have a shot here to be a proper competitor to Wayfair and kind of steal a good portion of that market from other traditional brick and mortar retailers like Bed Bath & Beyond, for example. Now, the other concern with this company is their balance sheet. So here you can see their assets, and what concerns me is that they have only around $11 million sitting in cash and cash equivalents with around $0 in investments. This may have been passable, however, when you look at their debts, they hold over $375 million in debt. So now you tell me, just objectively here, if I told you I have this company that has $11 million in cash, but $375 million in debt, does that sound like a strong balance sheet? In my opinion, it does not. What I also don't like is that they have so much sitting in inventory here, and this just keeps increasing substantially year over year. And as an investor, this really concerns me because it's another level of risk that you're undertaking by owning the stock, and they may have to resort to cutting prices in the future to clear out this inventory. This is something that I see often overlooked by investors in the retail space. So if you are considering investing in the stock, or you hold similar stocks like this that hold inventory, make sure you look at that inventory line to see how much inventory that company holds and if that is increasing substantially year over year. That's typically a red flag for me, and I want to look more into that if I'm seriously considering investing in that stock. And since we talked about Wayfair earlier, let's take a look at their balance sheet here. And you can see their investments and assets add up to around $975 million. And although their inventory is increasing year over year, it's still at a manageable level here at around $46 million versus At Home's $382 million. Wayfair has around $738 million in debt, which is high, but their cash and investments in this case do outweigh their debt, so the risk is significantly reduced. Now at this point, you may have an idea of kind of where I stand in my opinion on this stock, but before we kind of conclude that, let's take a look at the charts here for At Home. The stock has taken around an 88% haircut from its highs, and all of this has happened in just about 1 year. I would personally see this as an extremely high-risk stock with high volatility, and even though it's at a current 88% discount, the fundamentals don't really give me a lot of confidence here to put my money into this business. My fear is that this stock may actually end up being a stock like GoPro or even a stock like Fitbit, where they have peaked in the past, crashed significantly, and since then have had a very tough time posing any sort of recovery. Now, I do know that Jeremy is aware of the risks of this company. I'm sure he's done his research on this company. However, if you don't do your own due diligence, just watch his videos, you may only see the good side of this company, and it may actually encourage you to go invest in that company as well. I would personally consider this stock, like I said, a high-risk company. I'm sure Jeremy also sees this as a high-risk company, and as a result, he will allocate funds accordingly. I don't believe he'll make this a significant portion of his portfolio. Who knows, maybe he will. But in my opinion, the risk is just extremely high in this stock, and it may not be worth the possible reward for the amount of risk that you're taking on right now. My concern is that a lot of his viewers are going to be looking at this stock and dedicating 20, 30, 50, even 100% of their portfolio to this company. And in my opinion, that could be one of the worst mistakes you could possibly make with any stock. Like, I wouldn't even go in and invest 100% of my money in a company like Facebook, which has an extremely strong balance sheet, extremely strong future in my opinion, and has everything pretty much going the right direction for it. There is still a lot of risk when you put 100% of your money into any sort of asset. Now, Jeremy released his 3 stocks for August video in July 20th specifically. And when I look at this website here that tracks Robinhood investors on particular stocks, you can see that there was actually a spike with this particular stock, which does raise a bit of concern for me because I know a lot of his viewers are Robinhood investors, and as other YouTubers have pointed out in the past, there is a trend, unfortunately, where they blindly go and invest in stocks that he talks about on his channel. I think the evidence here is pretty much clearly telling us that there was a portion of his audience that did go out and buy the stock as soon as that video was released. So those investors that actually went in and blindly bought this stock, take a second, do your own due diligence, and figure out if this company is one that you want to hold for the long term. I'm not here to tell you what to do with your money. It's your choice. Put it in at home if you wanted to and just kind of ride that out. But what I am here to do is teach you that it is important to do your own due diligence, because in the end, you can't really point your finger at anyone else if you end up losing money in the stock market. I personally will not be buying at home stock, especially not currently. And if I did want to enter this space, I would look at a company like Wayfair, like we talked about previously. Wayfair stock has been hit recently and is kind of undergoing a correction right now. So maybe a good opportunity to look more into this stock and potentially investing in this as opposed to at home. But either way, guys, please make sure to do your own due diligence and drop a huge like on this video if you enjoyed my due diligence here on this stock. If you want to see any more videos like this on a particular company, make sure to comment it down below, and if there is enough interest in that, I will make a video on that as well. Thank you so much for watching, guys. Don't forget to invest positively, and I'll see you in the next one.